Hi everyone, welcome to our channel once again. Today I am here to revise along with you all two chapters, leverages and cost of capital from our financial and strategic management subject. Okay, I had already announced my dates last week and I had told you all that I am going to come up with the entire revision of important chapters, and these two chapters are going to cover your 15 marks in the exam. Okay, so I am going to revise this entirely from the basics. What are the formulas? Okay, the past exam questions, the one which are probably asked in almost all the attempts. Okay, so similar type of those questions. I have also prepared some practice questions. After we do the revision, we will solve some practice questions and then go to our exam questions. Okay, so be with me, write down all your formulas. Okay, take a notebook, take a calculator, solve along with me, and they are very easy and very scoring chapters. Okay, they are not that very lengthy, so they are very scoring. Leverages and cost of capital. So first I'm going to begin with leverages and then we will go to cost of capital. Okay, along with that, do please join our social media groups, WhatsApp group, our Telegram group, so that you can keep yourself updated with what all revision classes I am going to come up with, the chapters I am going to discuss with you all. So you will have all the updated news about that. Okay, so now we will begin with leverages. All right, come. Okay, so what is leverages? Okay, basically, okay, what is leverages? Once we will understand the meaning of leverages, the formulas are going to be like, it will be like an ease. You will not have to mug it up. Okay, so leverages is a relationship between two variables. Okay, simple. If I am telling you two variables, I have two variables. I have sales and I have profit. Okay, so if I tell you my sales is increasing, obviously my profit is also increasing. Okay, a relationship between how much sales I have to make in order to generate X amount of profit. A relationship, a direct relationship between the variables. Okay, so there are two variables over here. One is a dependent factor and one is the independent factor. Okay, so from the finance point of view, okay, it shows a relationship between sales and profit. Okay, simple. It shows relationship between sales and profit. So say if there is a 10% increase in my sales, there will be increase in the profit, but not necessarily, it will not necessarily be in the same proportion. It can be in a different proportion. Why? Because there are some fixed expenses which come on our way from sales until we reach to the profit. We have many other expenses which are fixed in nature, which are going to affect our profit also, and the variation will be different. Okay, there will be increase in the profit, but necessarily not in the same proportion. Okay, so leverages calculates the speed at which the profit will change due to involvement of certain fixed costs which we already have. Okay, so say if, for example, sales, if it will go, sales is up by 1%, you will feel that the profit has increased by 4% because of that fixed expenses which are there, which we put in our P&L income statement. Okay, so here simply I can say that my leverage is 4. So say tomorrow, if my sales has gone up by 20%, 5%, obviously my profit will increase by 20%. Why? Because my leverage is 4. So it is simple. 5 into 4. Okay. And similarly, if the sales will drop by 1%, my profit will also drop. So if there is an increase in sales, there is an increase in profit. But similarly, if there will be a decrease in sales, there will be a decrease in profit. Okay. So if there are more fixed costs, there are high fixed costs, there is a higher risk, there is a higher leverage. Okay. So with this, why am I explaining all this theory part? So that if there is any theory MCQs, you can attempt it immediately. Okay. Now, before I go to anything else, I just want to first talk to you all about an income statement. Okay. Let us discuss our income statement. What is an income statement? Very important. Once we will know our income statement, our formulas will be automatically, we will know all our formulas. We do not have to mug up. Okay. So first I start with my sales. Okay. For example, my sales is say 100 minus my variable cost. Directly, which varies with the sales, directly variable, directly related to sales. The amount of sales I will do, the amount of variable cost I will have. So say my variable cost is at the rate of 40%. So your variable cost is 40. That will give me my contribution, which is nothing but 60. Now if I am telling you that I have a fixed expenses, okay, of 20. Now fixed expenses remains the same irrespective of the sales. Okay, today if I am taking a class or if I am teaching in a class, okay, irrespective whether I have 10 students or I have 100 students, there are certain fixed expenses, for example, rent, electricity bill, etc., which is going to remain same irrespective of the number of students, right? But variable costs, like say giving of notes, printing of notes, providing them with that, okay, that can change. So fixed expenses are going to remain fixed irrespective of the sales. So I can say that my EBT, earnings, or NPBIT, there are, NPBIT, I'll write both the names. Net profit before interest and tax, or earnings before interest and tax, is going to be 40. Now obviously there can be certain loans taken, so there can be an interest factor which is there, a finance cost which is involved. Okay, there is an operational cost, yes. Now there can be a financial cost. These are all operational costs, these variable costs, fixed expenses, these are required for doing our operational activity. Interest is a finance cost. Say I am paying an interest of 10 rupees. Okay. So now my NPBT, net profit before tax or earnings before tax, is 30. Coming to my tax. Okay. Now say I have a tax rate at the rate of 50%. So my tax is 15. So my earnings after tax or net profit after tax or earnings after tax is going to be 50. Right? Okay. So here this income statement, with the help of the income statement, I will show you how does a leverage work. Now since I already told you leverage is a relationship between sales and the profit. Okay, sales and the profit. There is a relationship between that. Now there are two types of leverages. One is the operating leverage. Okay, operating leverage. Now operating leverages talk about the relationship between the sales and the profit which is coming due to the operational activities. Okay, so operating leverages, now obviously one operating expense over here is a fixed expense. Okay. So what is there between the fixed expense is between contribution and NPBIT. So simple, degree of operating leverage is nothing because it is due to an operational expenses. Okay, it is going to show us the relationship between sales and the profit due to that particular fixed expense. So my degree of operating leverage is nothing but contribution upon NPBIT. Easy, degree of operating leverage. Okay, then we have financial leverage. Financial leverage. Right? Now financial leverage, that means we are talking about a financial cost. Operating cost is done. Now I am talking about my financial cost, which is interest. So basically my interest is falling between NPBIT and NPBT. Okay. How much is going to, how much change is going to come in my earnings before tax due to my financial cost. Okay. So here the formula will be degree of financial leverage will be nothing but change in one variable and the other way. So your two variables are NPBIT upon NPBT. Okay. How much is NPBT going to change due to the change in NPBIT? Okay. Because there is a fixed expense, financial expense involved over here. And every time when we do leverages, the answer which we get is in times. It is 2 times or 4 times or 5 times, whatever. Okay. So say if contribution is changing by 1 time, okay, we are not taking sales, we are taking contribution. This is how the formula is. Okay, so if there is a change in the contribution by 1 time, then how much is NPBIT going to change? Okay, or 4 times or 5 times, that is going to always be in times. Now coming to the degree of combined leverage, this is 1/3 last formula. Okay, degree of combined leverage, which is nothing but degree of operating leverage into degree of financial leverage. Easy. Okay, now if I do this degree of operating leverage, I told you it is contribution upon NPBIT. Degree of financial leverage is NPBIT upon NPBT divided by NPBT. Right. If I cancel, okay, NPBIT and NPBIT, I am left with contribution upon NPBT. Combined leverage means both the cost, fixed cost, operational and financial, are considered into this particular leverage. So it is falling between contribution and NPBT. So this is how the formula is arrived for all the 3 leverages. Okay. I hope you all have noted this down. Even if not, do not worry. This income statement is also going to come ahead later. Okay. So we are done with 3 types of leverages: operating, financial and combined leverage. Okay. So we already have this formula: percentage change in EBIT upon percentage change in sales. Okay. Or simple contribution upon EBIT. All our sums, when you will see, they are based on this formula. Okay. Right. So say for example, this is an important example. Degree of operating leverage is 1.33 times. What does that mean? It indicates that EBIT is more sensitive with respect to the change in sales. So if say tomorrow sales is going to increase by 10%, then EBIT will increase by 13.3%. Simple. How I got that? 1.33 is the leverage into 10. So you see, not necessarily it is changing in the same ratio. Sales is changing by 10%, but my EBIT is changing by 13.3 times. Okay, right? So change in the income change in the sales. Okay, this is what we are talking about, the leverage. Then we spoke about degree of financial leverage. What formula we have to know is Npvit upon Npvt. Okay, or percentage change in the earnings before tax upon percentage change in EBIT. Okay, then how does a financial leverage work? We all know companies, they have share capital. Of course, they have their own capital. Sometimes they even take a debt. Okay, so then there is a financial leverage which is in the form of interest, is the cost to the company, right? Interest is a cost to the companies. Okay, so they basically take all this debt and then they invest in the assets. Degree of combined leverage, it is the entire relationship between the entire income statement is covered here fully. Okay, so here relationship between the combined leverages between both the degrees. Okay, it is a product of both the leverages, degree of operating leverage and degree of financial leverage. Okay, so this is how the formula is arrived, contribution upon EBIT. Okay, so EBIT, if I cancel, contribution upon earnings before tax. Okay, now we all know what is a profit volume ratio. Okay, profit volume ratio is a ratio of contribution over sales. So there is only one additional formula in case if they happen to ask anything based on profit volume ratio. Okay, so your profit volume ratio is nothing but the formula is very simple. Here it is given, profit volume ratio is nothing but contribution upon sales into 100. Why into 100? Because it is always in the form of percentage. Okay, so in say example, if sales is 100 and they are saying my profit volume ratio is 60%, in simple words it means that contribution is 60 and variable cost is 40. Simple, 60%. Okay, so my profit is, means profit volume means contribution. Another word of contribution you can say. Okay, so if my profit volume ratio is 60% and sales is 100, my contribution is going to be 60. Okay, see, here is my income statement once again. Okay, so my income statement, sales, from my sales, yes, I minus my variable expenses, I will arrive at contribution. From there, I will minus my fixed expenses, EBIT, less interest, NPBT, less tax, NPV. Now, if they ask you, if they go ahead and ask you anything based on earning per share, so earning per share is nothing but the amount available as a profit to equity shareholders here. This is the amount which is available for the equity shareholders. Okay, divide by number of shares if they will provide us. We will arrive at earning per share. So everything if you say is based on your income statement. There is nothing new. You don't have to learn and mug up the formula. Okay, write down the formulas on a separate notebook so that you can revise it before practicing. Okay, now let us solve a few sums and make our concepts clear, the basic concepts clear. Okay, sure. First they are saying find operating leverage. Okay, and then later on they are also saying also find the degree of financial leverage. Okay, so first we have to find operating leverage. Just for our understanding, I am writing the degree of operating leverage formula over here. It is nothing but it is contribution upon Npvit. Okay, so we need to know contribution, we also need to know Npvit. And degree of financial leverage is nothing but Npvit upon Npvt. Just writing the formula. Okay, if we will write more, the more we will remember. Writing will always make you, it will give you best way of practicing practical sums, these practical subjects is to write. okay, is to solve actually. And even in, you should take this as my best guidance, is whenever you will write now, you will remember. Okay, whatever you will write, you will visualize, you will see, and you will remember. Okay, so make a practice, have that habit of writing. Okay, now we will just, I will quickly make an income statement. Then we have to just put the numbers in the formula. Nothing we have to do. Okay, so let's start with sales. Okay, sales is 50,000. Okay, minus variable cost. They have given me variable cost in the form of percentage. Okay, so 50,000 into 60%, 30,000. So now contribution is 20,000. Contra is 20,000. Okay, they have also given me my fixed cost. Fixed cost is never in the form of percentage because it is fixed in nature. Okay, so 12,000. Okay, so here it will be now 8,000 Npvi. So I have got my two variables with the help of the income statement. I will just put it in my formula. Contribution is 20. Npvi is 8,000. Okay. So my degree of operating leverage is, if you will calculate this, it will come to 2.5 times. Yeah. I hope you all are following with me. 2.5 times. Okay. Now for the next sum. Okay. Now it is not a continuation. Okay. So for the next sum, let's see. They are telling me my Npvi they have given me. So I'll start my income statement with Npvi. They are telling me it is 20 lakhs. Okay. Npvi is 20 lakhs and my debt is 75 lakhs on which I am paying an interest of 12%. So from here I will minus my interest. Okay. So interest of 12% I will take on my debt. So 75 lakhs into 12%. That is going to come to 9 lakhs. Okay. This is NPBT now, which is 11 lakhs. I have my NPBIT 20 lakhs upon NPBT 11 lakhs. Okay, if you will solve this 20 lakhs divided by 11 lakhs or 20 divided by 11, it will come to 1.82 times. So one is 2.5 times, the other answer is 1.82 times. I hope our basic concepts of just knowing what is an operating leverage, how to solve a degree of financial leverage is easy. Okay, quickly, not less than 1 minute, also not more than 1 minute you should take for this particular type of questions, and you will see how the exam questions are. Trust me, they are on the same lines. Okay, nothing big here. Okay, nothing much. Okay, now see here, very easy again for the practice purpose. They are telling us there is an income statement which they have already prepared for us for Zenith Limited. Sales is 10 lakh 50. Okay, there is a variable cost of 7 lakh 67,000. We have the fixed cost. They have given us EBIT. They have also given us interest, tax and net income. They are telling us to calculate and interpret the following. We have to calculate degree of operating leverage, degree of financial leverage and degree of combined leverage. Okay, so degree of operating leverage is nothing but contribution upon NPBIT. Okay, if we don't need to make the income statement once again. We all know contribution is nothing but sales minus variable cost. Okay, so simple, it is going to come 10,50,000 minus 7,76,000, which is going to be 2,83,000. Okay, so here it will be 2,83,000 divided by Npvit, which they have already given to us, 2,08,000. Okay, so 1.36 times is my degree of operating leverage. Okay, you all can try by yourself also, please. Degree of financial leverage, the formula is Npvit upon Npv. They have given us Npvit 2,08,000. Okay, NPBT means net profit before tax. Okay, so net profit before tax is nothing but NPBIT, net profit before tax is nothing but NPBIT minus interest. Okay, so it is going to come as 98,000. Alright, so your degree of financial leverage is 2.12 times. Alright, and last they are asking me degree of combined leverage, which is degree of operating leverage into degree of financial leverage. Simply 1.36 into 2.12, which is nothing but 2.88 times. Okay, so again we have practiced all three formulas. Now let's move to a little bit of different type of sum. Okay, now we will see what is a bit different over here. Okay. They are saying this is another type. Okay, same thing we have to do. We have to find all the three leverages, and then we have to find using that leverages we have to calculate the increase or decrease in the profit, or how much a particular, if there will be a particular change in the sale, how much will profit change, etc. Okay, otherwise up till finding all the three leverages nothing changes, same thing. Okay, so here the income statement is given to us. Sales is 4 lakhs, variable expense is 35%, 1 lakh 40, contribution 2 lakh 60, fixed expense 1 lakh 80, EBIT is 80, interest is 10,000, and taxable income. Taxable income is what? Net profit before tax, basically they are saying. Okay, so taxable income is nothing but NPBT. Net profit, these are different words they use. Okay, so now they are saying you are required to submit the following to the management. What percentage will taxable income increase if the sale increases by 6%? Okay, if the sale is going to increase by 6%, what percentage will taxable income increase? Okay, this particular. So they are asking us the relationship between sales and the taxable income. So looking at the income statement itself, I can understand that in order to find this, I will have to know my degree of combined leverage, because both my fixed costs and my interest costs are covered. Okay, the relationship between the two extremes they are asking. Then they are asking me what percentage will EBIT increase if there is a 10% increase in sales. Here they have given us the hint. Use operating leverage. Here also they have given us the hint. Use the combined leverage. But what if they have not given to us? What percentage will EBIT increase? Okay. What percentage will EBIT increase if there is a change of 10% increase in the sales? Okay. So sales and EBIT, between them there is only one particular cost, fixed expenses. Obviously I am going to use my operating leverage over here. And the last one is, what percentage will taxable income increase if EBIT increases by 6%. So now in the last one, they are asking me, okay, the relationship between EBIT, okay, relationship between EBIT and the taxable income. Okay, so yes, here I will be using my degree of financial leverage. Okay, so first I will find all my 3 leverages and then I will be able to arrive with the answer. Okay, so let's do the first one, degree of combined leverage. Degree of combined leverage is nothing but, if I am putting a formula over here, okay, it will be contribution upon NPBT. Contribution is 2,60,000. NPBT is how much? 70,000. So the answer here, it is 3.714. Calculate 3.714 times. Okay. So now what is happening? I'm just giving a small note over here for your better understanding. Okay, there is sales, change in sale, and they are asking how much will my NPBT change with the change in sales. So two variables I am writing. Okay, say for example, now with the help of my degree of combined leverage, whenever my sales is changing by 1%, my NPBT is changing by 3.714 times. This is what is the meaning of the leverages, right? That if my sales will change by 1%, my NPBT will change by 3.714%. So now they are telling me, what if suppose sales is going to change by 6%, by how much is this going to change? Okay, so basically simple cross multiply. Okay, just for your concept clearing, I'm giving you all this. Otherwise, we all know that in order to find this, we'll just do 6 into 3.714. Okay, so when you will do this, you will get an answer as 22.284%. So I'm just writing this note that if, therefore, if sales increases by 6%, then taxable income, okay, then taxable income, net profit before tax, will increase by 22.284 times, by percentage, sorry, not times, percentage. Okay, these type of sums are important. They will either ask you the leverages or they will ask you the relationship type of sums. Okay, there is nothing, there is no rocket science in this. It is simple multiplication, and I have showed you the concept behind it. Okay, so if you do not remember the formula, didn't know what to multiply, you can even put this, use this and understand. Okay, next one. I have to first find my operating leverage. Okay, so I am solving here so that the question also remains on your screen. Okay, what percentage will EBIT increase if there is 10% increase in sales? We use operating leverage. Okay, fine. So degree of operating leverage. What is our formula? Contribution upon NPBIT. How much is our contribution? 2,60,000. Our NPBIT is 80,000. Okay, so our answer is 3.25 times. Okay, so now if I am making a note of it, okay, the same concept I am using again. Okay, two variables. There is sales, and they are asking about EBIT. So I understood that when the sale is changing by 1%, since I'm talking about degree of operating leverage, my EBIT is changing by 3.25%. Okay. So if my sales is going to increase by 10%, then how much is my EBIT going to increase by? So simple again, cross multiply. So that I can do it here also into 2. 3.25 into 10, it will become 32.5%. So can you see the amount of change? Sales is just changing by 10%, but profit is increasing by 32.5%. Okay. Now the last one, what percentage will taxable income increase? If EBIT increases by 6%, we are supposed to use the financial leverage over here. Okay. So degree of financial leverage, it is NPBIT upon NPBT. How much is our NPBIT? We'll just take it from here. NPBIT is 80, NPBT is 70. Okay. So 80 divided by 70,000. It is coming as 1.14 times. Okay. Two variables. We are talking about NPBIT and NPBT. Okay. So two variables. If NPBIT is changing by 1%, NPBT is changing by 1.14%. So if there is a change of 6% in NPBIT, how much will this change? Cross multiply. The answer is going to be 6.84%. Okay. So I hope these sums have made your concept of leverages chapter clear. Okay. Now, alright. Okay. There is some type of a similar sum, okay, wherein they have already given you the you can make the income statement and you have to find all the three leverages. Okay, by what percentage the sales should decrease to get BP, at what sales amount EBIT would be rupees 5.2 lakhs, and by what percentage change will take place in EBT for 10% change in EBIT. So we are supposed to use these three leverages only in order to find all these type of answers. Okay, now right now you all will feel that, oh my god, what is this? What are they asking? But you will trust me, it is so simple. Okay, so let's start. First, I am just making my income statement. Okay, so I am starting with sale 30 lakhs minus variable cost, which is 60%. So 18 lakhs. 12 lakhs will be my contribution. Okay. Minus fixed expenses, which they have given me as 2 lakhs. So NPBIT is 10 lakhs. Minus interest, which is 6 lakhs. So my NPBT, net profit before tax, is nothing but 4 lakhs. Based on this, I have to find my all the three leverages. So my degree of operating leverages is contribution upon NPBIT. Okay, contribution 12 lakhs, NPBIT 10 lakhs. When you will put that, it will be 1.2 times. Degree of my financial leverage, NPBIT, which is 10 lakhs upon NPBT, which is 4 lakhs. 2.5 times. Degree of combined leverage, degree of operating into degree of financial leverage, it is going to come as 3. All my 3 leverages are now in place. Now I will start answering the question. So first one is 1. Calculate all the 3 leverages. Second, by what percentage sales should decrease to get a break-even point? Okay. So basically, what does BEP mean? BEP is nothing but the break-even point. The chance for this particular type of a sum is very rare, but since it's also given in your module, we need to know certain concepts. It can be a surprise element. So if it comes in your exam, you will be able to solve it, and it is not difficult. Okay. So break-even point is nothing but that stage where there is no profit, no loss. No profit, no loss. Okay. So where there is no profit, no loss, it is known as a break-even point. So they are telling me that how much you should decrease your sales, how much should your sales decrease so that your NPBT becomes 0. Okay, fine. So say sales and NPBT. When my sales was 30 lakhs, my NPBT was 4 lakhs. Between sales and NPBT, I am going to use my degree of combined leverage, which is 3 times. They are saying that by what percentage should your sales decrease in order to get a 0, okay, no profit, no loss in NPBT. That means that you should get 0 over here. 100% decrease, no, only then it can become 0, no. Minus 100%, no, over here. Right. So, since I am using my combined leverage, basically, it will be, if my sales is going to decrease by 1%, my NPBT is going to decrease by 3 times. Right. But what if my NPBT is itself decreasing by 100%? Then how much is my sales going to decrease by? So same thing I have to apply. Okay, so this is X. So 3 into X is equal to 100. So X will be equal to 100. Don't put that minus sign right now. Upon 3. So it is going to be 33.33% decrease will be required in sales, so that my BEP, I will reach at a break-even point. Okay. I have used my combined leverage, same concept of cross multiplication I have done here. In the previous sum, they were giving us the change in the sales and we were finding NPBT. Right now they are telling me the change in the NPBT and I am finding the sales. That's it. There is nothing new. Okay. Now coming to the next question. At what sales amount EBIT would be rupees 5.2 lakhs? They want my EBIT, earnings before interest and tax, net profit before interest and tax, to be 5.2 lakhs. Right now my NPBIT is how much? 10 lakhs. Current. Okay, current NPBIT is equal to 10 lakhs. In order to bring it to 52 lakhs, there is a decrease. So how much of percentage decrease is there? There is a decrease. So NPBIT is basically decreasing. If you will calculate this, it will come to NPBIT is decreasing by 48%. Okay, it is decreasing by 48%. Why? Because I will have to decrease this minus this 4,80,000. Okay, from 10 lakhs, I have to decrease that to 4,80,000, decrease by 4,80,000. Only then I will arrive at 52 lakhs. So basically, it is a 48% of decrease I will have to do in my NPBIT. Okay, so now again the same concept, NPBIT and sales they are asking. Okay, so sales and NPBIT. So between sales and NPBIT, I am going to use the degree of operating leverage. Okay, so operating leverage is 1.2 times. So that means if sale increases or decreases by 1%, NPBIT is changing by 1.2 times. Now I know NPBIT is decreasing by 48%. So how much is my sales going to decrease by? I have to find that. So 1.2 into X is equal to 48%. So X is going to be equal to 48 upon 1.2, which is going to be 40%. Decrease by 40%. Don't put minus sign to confuse yourself over here. Okay. So my sales has to decrease by 40%. Only then I can get my NPBIT as 5,20,000, 5.2 lakhs. Okay, so if I'm changing my sales, okay, so sales is 30 lakhs. Decrease your sales by 30 lakhs. 30 lakhs into 40% minus 40%. It will become 18 lakhs now. So sales will be equal to 30 lakhs minus 40%. That will now become 18 lakhs. So you can even reconcile it later on. You can put now this 18 lakhs in your income statement and see that your NPBIT will become 5,20,000. Okay, what was your new to find was this, the percentage. In order to come to 5,20,000, I will have to decrease by 4,80,000. So how much percentage change is happening over here? 4,80,000. In case even this, if you all want, divide by 10 lakhs. Okay, into 100, 48%. Okay, so this is the other question attempted. Now the last one is, what percentage change will take place in EBET for 10% change in EBIT? Simple. This is using the financial leverage. Okay. Degree of financial leverage is how much? We just found out, right? 2.5 times. Okay, so 2.5 times. There are two variables, NPBIT and NPBT. Okay. So here, if NPBIT is changing by 1%, NPBT will change by 2.5%. Now they are saying how much is NPBIT changing? By 10%. NPBIT is changing by 10%. So how much is this going to change for? So cross multiply. Simple. It will become 25%. This is direct. Okay. So these are the important practice questions from my end. In fact, if you will practice this, you will be able to solve all these exam questions each other. Okay. Now let's go to the exam questions. Past year exam questions. I have taken those one which are to be likely to be again and again they have repeated in the attempts. Okay. So let's see. First one, a firm has a degree of operating leverage of 5, degree of financial leverage of 4. Interest burden is rupees 300 lakhs. Variable cost as a percentage to sales is 75% and the effective tax rate is 45%. Okay, what is its fixed cost, they are asking. Okay, so degree of operating leverage is equal to 5 and degree of financial leverage they are saying is equal to 4. Okay, this only I'm just writing this. And we already know interest is 300 lakhs, variable cost as a percentage to sales is 75%. Okay, and the effective tax rate is 45%. Okay, now degree of operating leverage, the formula is contribution upon Npvi. Okay, so now I need to know my Npvi. I also need to know my contribution. So let's go to that first. Okay, first find the Npvi and also find the contribution. So now I'm just making one small income statement, sales, okay, minus variable cost, that will give me my contribution, minus fixed cost, that will give me my Npvi. Okay, so now then I have my interest factor, Npvt, then I have my tax rate. Okay, so Npat. They have an interest burden here. I know it is 300 lakhs. Okay, so I'm just writing interest over here is 300. Tax rate is 45%. Okay. Now, if tax rate is 45%, that means, say for example, this is 100 minus 45, Npat will be 55%. I'm just writing and keeping it, and I'm finding out the various other factors which we can fill in this. Okay, fine. Right now I am just able to fill this interest factor. Let's move to the other formula and see if we can find it. Degree of financial leverage. They are saying it is EBIT upon EBT, and they have given me that as 4. Okay. I know the meaning. What is EBIT? Basically, I know interest before earnings before interest and tax, and EBT is I am arriving at EBT when I am subtracting EBIT minus interest. Okay, I am just trying to put in few formulas and try to find one more factor so that my income statement will get completed by some or the other ratio so that I can find the fixed cost quickly. Okay, so now I know my degree of financial leverage is 4. EBIT is something which I don't know. Okay, so I am writing this as it is, but I know my interest factor. Okay, 300 lakhs. So now I am multiplying 4. I'm just putting it in the formulas. Okay, EBIT, solving the equation. Okay, so now I will have only one unknown variable. No, so 4 EBIT minus this will become 1200. 4 into 300. Okay, one very interesting sum. Huh? Okay, so here 4 EBIT minus EBIT. Okay, basics of maths when from one side of the equal to sign. you're shifting a particular variable to the other side, the sign will change. Okay, so this will become 1200. So 3 EBIT is equal to 1200. EBIT will be equal to 1200 divided by 3. So now this is going to become 400. That means 400 lakhs. So I got one more variable. EBIT also now I have it. So I can put it over here. EBIT is how much? 400 lakhs. Okay. Now they are asking me my fixed cost. Okay. Fine. Now I know my EBIT. I also know my interest. Now I have to find my fixed cost. Let us use the degree of operating leverage now. Degree of operating leverage, contribution upon Npbit. Degree of operating leverage they have given me as 5. I do not know my contribution. But now I know my Npbit, which is 400 lakhs. So 5 into 400 lakhs will give me my contribution. So basically 2000. 2000 is my contribution, 2000 lakhs. Okay, so I am putting contribution here as 2000. So now I need to know my fixed cost. Now it is simple. Simple, right? Contribution minus fixed cost was giving me my Npbit. I know my contribution. I don't know my fixed cost, and I know my Npbit, which is 400. So basically my fixed cost will now become 1600 lakhs. Okay, so I am going to 2000 minus 400 here, 1600 lakhs. Only then I'll get this answer, no? 400. Okay, so it seemed very easy when we read it. Just find the fixed cost. But when we started putting it in the income statement, okay, so now all this is not needed only. Basically, this is just for the information purpose. Okay, so here we can just put until Npv2, which is 100. Simple as that. Okay, so this sum was a very interesting sum. You all should definitely make a note of it. Okay, it can be asked in the exam. Coming to the question number 2. Okay, X company has a sales of rupees 12 lakhs, variable cost is 50% and fixed cost is 2,50,000. Operating leverage of the company is, okay, so I am making the income statement, you all find the operating leverage. Okay, 12 lakhs minus variable cost, they are saying it is 50%. Obviously 50% of sales, 6 lakhs. So my contribution is 6 lakhs. You don't have to make the income statement at during the exams. We all know degree of operating leverage is contribution upon Npbit. You should know how to find contribution and Npbit quickly in the formula itself. Okay, but if in case you are finding it difficult, your income statement is not going to take you more than a minute. Minus fixed cost is also given 2,50,000. So my Npbit is nothing but 3,50,000. So contribution is 6 lakhs. Npbit is 3,50,000. So answer is 1.71 times. This is an exam question. You can see here. Okay, easy, very easy. Okay. Coming to the next one. Capital structure of ABC Limited consists of equity share capital, rupees 1 lakh. They have 10,000 shares of rupees 10. Very good. Then they have 8% debentures of rupees 50,000 and earnings before interest and taxes 20,000. The degree of financial leverage is, okay, now they have given me NPVIT, earnings before interest and tax, which is 20,000. Okay. They've also given me my equity share capital. They're also telling me debentures. I am interested in my interest because I want to find degree of financial leverage. So I'm starting my income statement from here on. Okay. Interest is 8% of 50,000. Okay. So it is going to be here. You have to just find this. This will be 4,000. How did I get this? 50,000 into 8%. This is the debenture interest rate. Equity share capital has no role to play over here right now. Okay, so here NPBT, which is 16,000. Degree of financial leverage, NPBIT upon NPBT, 20,000 upon 16,000. That is going to be 1.25 times. Until now, though, the formulas are already learned. You cannot make a mistake now. Just not make any mistake. Okay. From the following information, calculate combined leverage. Okay. For combined leverage, let's start. Sales is 20 lakhs. It is very easy for me to make this income statement and then do everything. 40%. Okay. So 8 lakhs. Variable cost at the rate of 40% there. So my contribution is 12 lakhs minus my fixed cost 10 lakhs. So my NPBIT is 2 lakhs minus my interest, okay, which is 8% on 10 lakhs. My borrowing is 10 lakhs, 8% per annum. So 80,000. So this is going to be 1,20,000 NPBT. NPBT. Degree of combined leverage. Generally, it is the product of operating and financial. Otherwise, also I have told you all what is the formula. It is contribution upon NPBT. Okay, the relationship between these two extremes. Okay, so contribution is 12 lakhs. NPBT is 1,20,000. Degree of combined leverage is nothing but 10 times. Is the answer. Okay. Now coming to another question. Sachin company has a sales of 75 lakhs, variable cost 45 lakhs, fixed cost 15 lakhs. Operating leverage will be how much? So sales 75 lakhs minus variable cost is 45 lakhs. Okay. So my contribution is nothing but 30 lakhs minus my fixed cost, which is 15 lakhs. NPBIT is 15 lakhs. Degree of operating leverage is contribution upon NPBIT, which is equal to 30 lakhs upon 15, 2 times. Simple, it is so easy. These are the exam questions, past exam questions, and others are also somewhat the same. Okay, now capital structure is your chapter and leverage is a part of it. And see the questions which they are asking for leverage. So it is a good topic to which you can focus. Okay, and try to get maximum marks from these type of, and even the theory now will become so easy for you all to attempt. Okay, so these are the most probable exam questions, repetitively asked, changing few numbers here and there. Okay, so I hope you all have noted down all the formulas nicely separately in a notebook, and you all have also solving with me. Okay, same thing now we are going to go ahead and do it in the cost of capital chapter. Okay, so in a minute we will start with, give me 2 minutes, we are going to start with cost of capital also. Okay, finish your, if in case a little bit of leverages here and there is left, you can finish that. Like entire revision is done of one chapter in 1 hour. Okay, with exam questions. So now next chapter, quickly, cost of capital. It is the most cutest chapter in leverage. Okay, it's so simple. It is only formula based. Okay, now whenever we talk about cost of capital, first thing you need to put in your mind, cost of capital chapter is from the company point of view. Company point of view, think from their point of view. Think from the company point of view. For them, when they are raising the capital, there is a cost involved in that capital. Okay. So whatever is the source of the capital or the type of the capital, whether they are raising equity share capital or in the form of debentures or in the form of preference shares, it comes with a cost. For example, for equity share capital, obviously they are going to give them dividend. For preference shares, they have to give them the preference dividend. For debentures, they have to give them interest. Okay, so there is a cost which is always assigned to the amount of money raised by the company. So this is known as cost of capital. Okay, just a minute. Okay. Okay. So from the company point of view, say the cost of capital is 10%. But if I am an investor in that company, I have invested my amount. Okay, I have given them the capital. So for me, there is a return. Okay, for me, there is a return also. So from the investor point of view, it is going to be a return in the form of dividend or in the form of interest, etc. Okay, now there is one very important reason why would a company raise the capital. Okay, why will company raise any amount of money? Okay, they raise capital for a particular project, to finance a particular project. Okay, to take up any type of an activity. Okay, so firstly, how do they assess this? Okay, why is cost of capital important? Why they have put it in the financial management? Understand, if I am taking up as a company, if I am raising money from the people, cost is there. I am going to take that money, invest in a given project. I need to know whether that project is going to give me more than the cost. Correct? So in that case, say if the project, the return on my project or the return on the investment, it is known as return on investment. Company point of view, return on my investment is 12% and my cost is coming to 10%, I will accept the project. But if it is going to be vice versa, wherein my cost for raising that money, my cost means I am a company, for raising that money is 10%, but the return is 8% only, I will not take up that project. That is why cost of capital is important. Companies need to know what is their average cost of capital. Okay. So in this chapter, we are going to focus on the average cost of capital, mostly on the weighted average cost of capital. So we know there are two ways where how company raise their funds. One is own funds and borrowed funds. In own, we have equity shares, we have preference shares. In case of borrowed funds, we have debentures and we have loan. Okay. Now, as I told you, purpose for evaluating our cost of capital. Say, this example will clear your cost of capital chapter totally. Okay. So say company has started a business with rupees 10 lakhs. Now how they have this 10 lakhs with them? 5 lakhs is in form of equity, 3 lakhs is in form of debt, and there is preference shares also of 2 lakhs. Okay, now cost for the equity. Cost of equity is denoted with KE, cost of debt is KD, and cost of preference is KP. Okay, now they have already given me that cost to the company for raising this capital is 20%. For equity, for debt it is 10%, and for preference shares it is 12%. So I can easily just multiply 5 lakhs into 20%, 3 lakhs into 10%, 2 lakhs into 12%. This will be my cost. So my total cost will come up to 1,54,000. Total cost. What is my cost of capital? My overall cost of capital is nothing but the total cost upon the total capital. My total cost I just calculated 1,54,000. My total capital is 10 lakhs. So I can now say that my average, my total, okay, KO is 15.4%. It is in the form of percentage. It is in the form of percentage, 15.4%. There is another manner of calculating this where we assign weights. Weights are important. Okay, even in the sums, you will see in the exam questions, they have asked to find the weighted average cost of capital. Average cost of capital we understood. Different sources, we found the cost from each source, okay, divided by the total capital. Okay, so it is the total cost upon the total capital in 200. But when they ask us about the weighted average cost of capital, it becomes important for us to find it in that manner, and again it is very simple. We have to assign the weights and then accordingly calculate. So the sum remains the same, 5 lakhs, 3 lakhs, 2 lakhs of share capital, debenture and preferential. Assigning of weights. How is weight assigned? Total is 10 lakhs. Total is 10 lakhs. So here 5 lakhs divided by 10 lakhs is 0.5. Then 3 lakhs divided by 10 lakhs is 0.3 and 2 lakhs divided by 10 lakhs is 0.2. This simple way of assigning the weights. That particular capital upon total, the weights will get assigned. Cost is already given to me. Weighted average cost of capital is nothing but the weights into the cost. So 0.5 into 20. Don't multiply it with the percent. See, what you can do is 5 into 0.5 into 20. You will get 10. 0.5 into 20. Don't take that percentage sign. Then again you will get a wrong answer there. Okay, you will try to do 0.5 into 20%. No, don't do that. 0.5 into 20, 0.3 into 10, 0.2 into 12. You will get as 10, 3 and 2.4. Total will be 15.4. Just put a percentage sign after that. Your answer is 15.4. So whether you did it with weights, not without the weights, your answer is coming the almost same. Okay. Now, They are saying that so the project will yield above, the cost should be accepted. Okay, so if the project, the return on my project, return on the capital employed, return on investments, these are all very important words. Okay, return on capital employed, return on capital employed, return on investment, all these are very important words. Okay, if that is more than the cost of capital, the project should be accepted. So in this case, my return is 12%, but my cost of capital is 15.4%. So in this case, it should be rejected. My return is way less than my cost. Okay. So now coming to, we all know there are different sources. I'm starting with the cost of debt. Okay. In case of debt, okay, basically what is the cost in case of debt? KD, the cost is interest. Okay, upon say the price of that particular debenture. Okay, they might give us the market price. If market price is not given, they might give us the face value only. And if nothing is given, we generally assume it to be 100. Okay, so basically here they give us the price. But in case of debenture, what happens is, because we are paying interest, due to that amount, our net profit before tax becomes less. And because of that, a tax benefit is there. A tax amount will reduce. So whenever there is a debenture, there is a tax benefit. So my formula will change here and it will become interest into 1 minus tax rate upon price into 100. Only then it will come in the form of percentage. Okay, into 100. Either you can do interest minus tax, calculate the tax, or this is the best formula is interest into 1 minus tax rate upon that price, market price or whichever price they are giving us. Okay, this is one formula for cost of debentures. There is one more formula wherein the life of the debt is given. We all know debentures are redeemable. Okay? It might have a life of 5 years, 10 years, etc. accordingly. So say suppose the life is 5 years. Life is 5 years means N is 5 years. Okay. If I am telling you they have to be redeemed, so there is a redemption value. Okay. So redemption can be at par, it can be at a premium, or it can be at discount also. Okay, at the time of redemption. So say when my issue happened, issue price or the sale price of my debenture was 100, but at the time of redemption I am going to give them at a premium. So my redemption value is going to be 120. And that debenture's life is for 5 years. So this extra 20 which I am going to give them, it is for that whole 5 years now. Correct? So for total 5 years it is. So here, in case of finding that, the formula changes. So your change will be what? Interest 1 minus tax rate remains there only. Plus this interest I am giving them. Company is giving them interest. But they are also going to give them that extra money, no? This 20 rupees. Okay, so redemption value minus sales value or issue price. Any term you can use. Upon N. Why upon N? Because this 20 you are going to give in one time only. So for number of years you will divide by N, no? To know for each year how much. Okay, upon which price should I take? Market price, face value, redemption price, issue price, what? So best I take the average of 2 into 100. Since it is in the form of percentage, that is why I am putting into 100. Okay, so in case of cost of debt, we have to remember that there is a tax benefit always. That is why cost of debt will come to a lesser cost than what is given. Okay. Coming to, you will come to know when we will solve a given sum. Cost of preference shares. Now what do we pay to preference shares? Obviously we pay them the preference dividend. There is also a dividend distribution tax which we have to pay from the company point of view. Upon again the price, whichever price they are giving us, market price or face value, whatever price it is. Generally whenever market price is given, we always take the market price into 100. So the answer will come into whatever percentage. Okay, so this is the formula for KP. What are we giving them? Company is going to give them the dividend, along with the DDT also is a cost, okay, upon the market price. Now life of the preference shares, if there is a life given, then I'm going to give them the dividend. Now even same thing like how it is in debentures, redemption can be at par, at premium, at discount. Even if it is at discount, don't change the formula. Formula will remain the same. Okay. If it is at discount means what? That the redemption will be say at 98. Issue price was 100. So it will be RV minus SV. 98 minus 100. Keep the formula same. Only then when you're solving you change the signs as and when required. Same thing. I'm going to give them dividend. Generally dividend distribution tax is not given. So it is always preference dividend only. Okay. So RV minus SV upon N, the whole thing is RV plus SV upon 2. The same thing what we did for debentures. Okay. So these two are extra formulas. Sometime one sum here and there I just saw over all these years attempts it was there. Okay. One sum. So I'm also going to solve that with you. Okay. Coming to cost of equity. Now in equity there are many things, okay. Firstly, we give them the dividend. Also there is a growth in the dividend, okay. There are many different ways of finding the cost of equity. Okay, there are 4 approaches I can say to find the equity. One is in the form of dividend. Company is giving them the dividend upon the price. So D1 upon the price, PO. Sometimes it is in the form of earning per share. How much is the shareholder earning? So earning per share upon the price. Whatever they have given in the sum, you will use it accordingly. Mostly, which is the most important formula we use is this. They generally give us dividend plus growth. That today dividend is 1 rupee, but tomorrow it is going to grow by 10% or 5%. So dividend today, okay, plus that growth. Okay, so whenever we are finding D1 is the dividend along with that growth factor. D0 will be the dividend given already. D1 will always be that 5 rupees plus whatever is the growth factor, say 5%. Okay, so D1 is always calculated with the help of that growth factor. Okay. So dividend plus growth formula is DPS, dividend per share upon or D1 basically. I will write here D1 upon price plus separately plus growth. Okay, and the one is the capital asset pricing model. Based on that also we find the cost of equity. Here capital asset pricing model says that see in the market there are 2 things. Okay, the one is a risk free security where there is no risk involved. You keep in your bank, you will get FD, risk free. Okay, there is no risk involved at all. Interest will keep coming. Okay, but that same money I'm putting in the market in the form of equity, there is a market risk. If I'm ready to take that risk, obviously I'm going to ask for more return. I'll ask for a premium in my return. Okay, so risk free rate of return plus, okay, I'm going to ask for a premium. Why? Because I am ready to take that risk. From shifting to a risk free to go to and invest in a risk market, there is a risk involved. Higher the risk, higher the return, you must have heard. So RM minus RF is my premium. Okay, risk premium you can say. How much is the risk is the beta factor. Okay, so this B is the beta factor. So cost of equity, 4 forms. Okay, 4 formulas. Okay, write down all the 4 formulas. It is important. Anyone they can give you the details accordingly. Apply the formula. Okay. Coming to cost of reserves. Now, what are reserves? Reserves are the basically they are the opportunity costs. I could have used that amount, invested somewhere else, got a particular return, but I did not invest. I kept it in my funds separately in my reserve in my bank. It is there. They belong to the equity shareholders only. So generally, cost of, if nothing is given in the sum, okay, cost of equity is the same as the cost of reserve is same as the cost of equity, because it is for the equity shareholders. The reserves belong to equity shareholders. But if you tell me ideally what is the cost of reserve, okay, practically it is the opportunity cost is the cost of reserves. Why opportunity cost? Because that particular amount could have been used for another purpose of investments, etc., which is now lost. So opportunity is lost. So opportunity cost is equal to cost of reserves. If they have not given us opportunity cost in the sum, you do not have to find opportunity cost. They will give you. If it is given, then that will be KR. But if they have not given anything, then whatever you will find for KE, that will be for KR. Okay, these are small components you have to keep in your mind. Okay, see here. Just this last line you all know. No? Yes, that's it. Other first line and the last line. Done. Over. Okay. Opportunity cost is cost of reserve, but if opportunity cost is not given, then cost of equity is cost of reserve. Simple. Okay. Now, price here. Okay, I'm taking price. No, everywhere PO, everywhere there is a price. What price? Market price. Okay, fine. Understood. Price means price for new issue. For the new issue. If I'm doing a fresh issue and they're asking me price for that. So then it will be the issue price minus whatever is the flotation cost. Okay. For the existing issue which is already there, I will take the market price. Okay. And now what is flotation cost? What is the meaning? You know, the cost which is incurred in order to come up with that issue, advertisement, underwriting, printing, etc. at the time of IPO. Okay, that is known as flotation cost. Okay, issue cost. So there are four composites: cost of debt, cost of equity, cost of preference shares, and cost of retained earnings. Okay, so weighted average cost of capital, we all know how to now find. We will just start with one example quickly. Okay, they have given us equity, preference, debentures, loan, and reserve. There are 5 components. Okay, so they have given me all the cost. They are telling me to find the weighted average cost of capital. I already did this type of a similar sum in the starting when we started with cost of capital. Okay, so how will I assign weights? It will be 2 lakhs divided by 10, 3 divided by 10, 1 lakh divided by 10, 3 divided by 10 into cost. Simple. Cost is already given to us. They have already provided weighted average cost of capital is 6.4%. Okay, easy. Now cost of capital. 2 things here. If nothing is given, okay, all face value, book value is given, you will calculate it as per the book value. But if they are giving you the market price, if they are giving you the number of shares, etc., and they are giving you the market price, then whenever we are solving that weighted average cost of capital, we have to keep in mind that we take the market price. Okay. Now all these concepts which I have just told you over this time, okay, you might find it difficult to remember, or oh, so many things are there in cost of capital. Ma'am told it's very easy. But now when we will put it in the sums, and we will solve it and practice it, all your formulas and all these concepts will come clear. Okay, there are many sums asked on cost of capital. Many sums. Come on, let's solve one basic sum. Very simple. Okay, a company wants to issue new 12% debenture of rupees 100, which is the face value, and the tax rate is 25%. They have given me 4 things. Either they can issue it at par, or at a premium, or at a discount. Okay, and the last one is at discount also there is a flotation cost also. Why are all these things given to me here? Because my price is going to change. Okay, cost of debenture is nothing. Formula if I am putting, there is no redemption value, sales value wala here. Okay, nothing. Okay, there is only issue price. All these are issue price. Issue price at par means face value is the same and the issue price is the same. At premium of 20% means 100 plus 20%, 120. Discount, it will now become 120. Okay, there is so much of discount, 25%, 20% of discount. Okay, so in that case the issue price will again change. It will become 100 minus 20. It will become 80. And in the last there is discount plus flotation cost. We will see what to do to find the issue price. So cost of debenture is nothing but interest 1 minus tax rate on the price. PO, whatever you can write. Okay. How much is the interest? Is 12. Face value 100. Okay. Interest is 12%. So 12. Okay, interest is always given on the face value, right? Okay, so 12 is my interest. 1 minus tax rate. Tax rate is 25%. So generally I write 0.25. 25% means 0.25. Okay, upon first one the price is at par. So here it will become 100 into 100. So when you will calculate this, this will come to 9%. Okay. This was A. Now B. A is done. B. Same thing again on top. 12 into 1 minus 0.25. But the price over here is going to change. It is at a premium. So 120 into 100. So when you will calculate this, this will come as 7.5% cost of debenture. Okay. C. Okay. C is with the discounted price. No, price is changed. 80 rupees it is become. So it is 12 into 1 minus 0.25 upon 80 into 100. So here this is going to become 11.25%. Okay, and the last one, the issue is at 10% discount. Also there is a 5% of floating cost. Now how is that calculated? Okay, now issue is at 10% discount. So issue price is equal to last one, 10% discount one. Okay, I am doing the D1. So issue price will be 100 minus 10%. That is going to be 90. From 90 now, don't stop here. Minus your flotation cost, which is 5%. So this is the discount factor and this is the flotation cost. Okay, so now when you will do 90 minus 5%, it will come as 85.5. This will be my issue price. So nothing, cost of debenture is equal to interest 1 minus tax rate upon the price into 100. So 12 into 1 minus 0.25. Here the price is going to become 85.5 into 100. So the answer is going to be 10.52%. Easy. Okay. So this was important here. Issue price changed here. In all the situations it changed, but here there was one more factor. Okay. Next one. Very good one. Okay. Company has existing debentures of rupees 100, but currently they are traded at 125. If market price is given, I will concentrate on that. Coupon rate means interest rate. Interest rate is 15%. You are supposed to calculate KD. Okay. So KD is nothing but interest 1 minus tax rate upon market price. Interest is how much? 15% of 100. So 15. 1 minus tax rate. This becomes easy to solve. 0.201. Simple. Okay. Upon the market price is 125 into 100. So this will come as 9.68%. 6%. Okay. Now coming to preference share. Preference share is of 50, but market price is 75. Coupon rate is 15%. Coupon rate means dividend rate. Tax is 20%. Calculate KP. Also calculate KP if there was a DDT also of 10%. So पहले simple वाला KP I am calculating. Cost of preference share is nothing but the dividend. It is the preference dividend upon the market price. Okay. Preference dividend upon the market price into 100. So preference dividend is how much? Okay. Preference share is 50. So preference dividend will become 50 into 15%. Okay, I'm going to give 15% on the preference share price, the face value, market price, whatever it can be. Okay, there is no preference dividend in the first one, so I am not written. Upon market price is 75. Okay, into 100. So 15% of 50 is 7.5. Okay, upon 75 into 100. So this will become how much? 10%. Okay. Now with the same thing there is also a DDT. Okay, so this was A. In B, here the same thing I will write. It will be 7.5 plus there is a DDT of 10%. Write it the way I am saying. Okay, write in the way I am saying 10%. Okay, upon 75. Okay, so here into 100. Okay, now when you will calculate 7.5 plus 7.5 plus 10% first you need to do 7.5. Okay, plus 10%, 8.25. Why am I saying that to write it in this way? Because you might go wrong in calculation. DDT, dividend distribution tax, is paid on the amount of the dividend. No? So I know my dividend amount is 7.5. Okay, it is 7.5. On that I have to pay 10%. Okay, so 7.5 plus 10% when you will do, you will get 8.25. So don't skip the steps, please. Upon 75 into 100. Now when you will solve this, it will come as 11%. Okay, so this is about the preference shares. Now, okay, KE. Face value is 100. Company expects to give a dividend of rupees 8 and company will grow at 7% per annum. Calculate KE. Okay, so now KE. Okay, they are saying dividend plus growth, they are saying, so D1 plus P0 plus the growth. Okay, dividend. Expects to give dividend. So it is D1, not given dividend. Okay, expects to give dividend means the dividend and then another year. Okay, future. Okay, so 8. Base value is 100. I'll take 100. Nothing else is given. Plus 7%. Okay, so here either you calculate it in the form of percentage or in the numbers. Only then you will get the correct answer. So D1 upon price cost, finish that as a percentage. If you want to know, finish that as a form of percentage. So this will become 8% plus 7%. So this is going to become 15%. Okay. Don't try to jumble up here. Okay. Don't confuse yourself anywhere, because these are simple sums and then you may just lose your marks for this small silly mistakes. Okay. So that is it. Now coming to the type 2 weighted average cost of capital. Come on, let's solve this. Because in the questions, in the exam questions also, they are asking most of this only. Okay, weighted average cost of capital. A and company has the following capital structure. They have 10% debentures, 10% preference shares. Now whenever this 10% means this is the, here this is the interest rate, here it is the dividend rate. Okay. Equity shares, they have 5,000, which is of 100 each, so 5 lakhs, and the total becomes 10 lakhs. The equity shares of the company, they are quoted at 102 market price, and the company is expected to declare a dividend of rupees 9 per share. Assuming the tax rate is 50%, we are supposed to calculate weighted average cost of capital. Come on, let's solve this. Okay. Source. Okay, sources, amount. I'm going to calculate in the form of weights only, and then the cost in the form of percentage. So here my sources, first is debentures, then is my preference share capital, and then is my equity share capital. Okay, so amount 3 lakhs, 2 lakhs, and 5 lakhs. So total becomes 10 lakhs, right? Total is 10 lakhs. If I am assigning weights, it will be 0.3, 0.2, and 0.5. Okay, now cost. I will have to first find the cost. Okay, so say for debentures, what is the cost? KD is nothing but interest 1 minus tax rate upon the price into 100. Interest is how much? 10%. So 10, of course, I will take on the face value. Nothing is given, so 10 on 100. Tax rate is 0.5, 50%. Price, nothing is mentioned. I am taking the face value, which is 100 into 100. Okay, I am assuming the price to be 100. So here it becomes 5%. So in the cost, I will put 5% here. Okay. Then cost of preference shares, nothing is given only about them. There is this directly they have given 10% dividend, nothing else is given. So here it will come 10 only. There is no DDT, nothing. So there is no need to change. Okay, and preference, and yes, equity shares, correct. KE, I am going to use the dividend formula, D1 plus price. D1 is they are expecting to give a dividend of 9 rupees per share, and the price they are quoted at 102. Okay, so this will become 8.82%. So I'm going to write here 8.82. So weighted average cost of capital, 5 into 0.3, 1.5. 1.5, this will be 2, and this will be 4.41. So 7.91 will be my weighted average cost of capital. Alright. Now coming to market value for the weights. Okay, this sum is a little lengthy, but it is very simple. They might ask you market value. Weights you have to assign as per the market value. So first we will do it as per the book value, like how we just did a previous sum, and then we will also do it as per the market value. Okay, determine the weighted average cost of capital using both book value weights and market value weights, weights. Okay. So debentures, preference shares and equity shares. Okay. Cost component already calculated and given to us. Very nice. So let's start. Source. I'm doing first one. Book value. Book value weights. Okay. Book value weights. So source is debentures, preference share capital and then equity share capital. Then we have amount. Amount, how much they have given to us? 8, 2 and 10. 8 lakhs, 2 lakhs and 10 lakhs. I hope you all are all solving with me these type of sums. Okay. Weights assign as per the book value. Total is 20 lakhs. Okay, so this will be 0.48 divided by 20. 2 divided by 20, 0.10 and this will be 0.5. So weights is done. Cost they have already given me. Just write the number. 0.4. No, then this is 14.87 and this is 17. Please copy from the question correctly at least. Weighted average cost of capital. Okay, you have to just multiply them. So 2.816. Yeah, 2.816. Then this will be 1.487 and this is going to be 8.5. So as per the book value weights, it is 12.803% weighted average cost of capital. I have used book value weights. Okay. Now this same question they wanted as per the market value weights. So now this is going to change for me. Okay, so I am changing this. Here I am going to use market value. Cost and everything remains the same, but I am going to use market value. In order to use market value, I'll have to write the amount also as per market value. So for debentures, it is 110 per share. How many such debentures I am having? There are 8 lakh debentures. They are telling me 8 lakh debentures are there of rupees 100 each. So I am having 8,000 debentures. No. So for debentures, it will become 8,000 into 110. That will be 8,80,000. Okay. For preference shares, it will now be 2,000 into 120. That will be 2,40,000. And equity share rupees 10 each. There are 1 lakh shares. Well, that means into 22. So that will become 22 lakhs. Okay, now do the total. Total will come as 33,20,000. Now assign the weights. Now the weight will be 8,80,000 divided by 33,20,000. Okay, it will be 0.2651. Okay. Then 2,40,000 divided by 33,20,000, 0.0723. And the last is 0.6627. Multiply them with the cost they have given and find the answer. Okay. This is 11.2659. So the total weighted average cost of capital total is 14.21%. Now yes, one very important question which students ask me, ma'am, there are MCQ formats, so they give us the options. So they will give you the closest option. Why? Because now you really don't know whether to take 4 decimals, 3 decimals, what have they done. You also try to come, you will always get a most close and most approximate answer as per the options they are given. Okay, so do not worry about that. Alright, I have taken up to the 4 decimals. Now I'm coming to the past exam questions. Okay, interesting part. Let's see. Okay, let us read this. Shyamalan Limited is currently financed with 5 lakh rupees of debentures, which is 10% coupon rate, and 15 lakhs of equity share. Equity share is having a beta of 1.5 and the risk-free rate is 6%. RF, risk-free. And the market risk premium, they have given me 4%. The tax rate is 20%. What is the weighted average cost of capital? Okay, now there are only two things here, debenture and equity share. So first I will try to find the cost of debt. Interest 1 minus tax rate upon the price into 100. How much is the interest? 10. Okay. Tax rate is 20. What is the price? I am assuming it to be 100 if nothing is given. So this will become 8%. Cost of debt is done. Cost of equity, since they have given me the risk-free rate of return, beta, etc. So I am going to use the CAPM model. Okay, in order to find this. RM minus RF. Risk-free rate of return, they are telling me it is 6%. Beta is 1.5 times. And market risk they have not given me. They have directly given me the premium. Market risk premium. This itself is a premium. RM minus RF, other word is the premium. Okay. The additional thing which you are getting to move to the market from a risk-free rate or security. So this is into 4. Right. So this will come as 12%. So I have KD, I have my KE. Okay. I just need to find the weighted average cost of capital. So here my sources is debt and equity share capital. Amount here is 15 lakhs. This is some 5 lakhs. No. Equity share capital is 15 lakhs and debt is 5 lakhs. Okay, weights I have already told you all how to assign it. So this is total is 20 lakhs. No? So this will become 0.25, 0.75. I have found the cost. Cost for the debt is 8%. For equity share capital, it is 12%. Okay. Multiply weighted average cost of capital. This is going to be 9. 2. Total is going to be 11%. WACC. Okay. Next question. A company issues 10,000 10% preference shares of rupees 100 each. They are redeemable after 10 years at a premium of 5%. Okay. So since they are giving me this information, that means I can find, I know N and I also know the redemption value, RV. The cost of the issue is rupees 2 per share. The cost of preference share capital is how much? So here my cost of preference share capital, I will have to use it as per that RV and RVSV formula. Okay. So here I am going to give them preference dividend. Okay. Plus I am going to give them the extra premium. The whole thing upon RV plus SV upon 2 average. Now redemption value is going to be 5% premium. No? So 100 plus 5%, that will become 105. And issue price or the sale time, issue price or the sales value is going to, cost of issue was rupees 2, I'll have to consider that. So 100 minus 2, that will be 98. Okay. So preference dividend is 10%, face value is 100. So 10% means 10 rupees. RV is 105 minus SV is 98 upon N. N is how much? 10 years. Okay, this whole thing multiply by 100 upon 105 plus 98 divided by 2. So when you will solve this completely, you will get an answer as 10.54%. Okay, 10.54. Next sum. Question number 3. ABC Limited has the following capital structure. Okay, they have an equity share capital rupees 10 lakhs, 10 preference share capital 5 lakhs, debenture 15 lakhs. Cost of equity is estimated as 15%. Calculate the weighted average cost of capital assuming the tax rate as 50%. Okay, so your cost of equity they have already calculated 15% given. Preference shares, no other information is given, so I am taking that as 10% only. What I just need to find is KD. Interest 1 minus tax rate upon price into 100. How much is the interest on the debentures? 8%. So 8 1 minus tax rate means 0.5. Price assuming nothing is given, so 100. So this is going to become 4% cost of debentures. So now it is so easy, nothing I have to do. Sources, amount, okay, weights and cost, weighted average cost of capital. I have equity share capital, preference share capital and debentures. Equity share capital is 10 lakhs, preference share capital is 5 lakhs, debentures is 15 lakhs, total is 30 lakhs. I have to assign weights. So 10 divided by 30, 0.33, 5 divided by 30, 0.167 you will get, 15 divided by 30, 0.5. Cost for equity already given, 15%. For preference share it is 10%, and for debentures I just found it is 4%. I'll multiply them all. This is going to be 5. Okay. This is 1.67 and this is 2. So the total weighted average cost of capital is 8.67%. Okay. Weighted average cost of capital is 8.67%. Easy sums. All exam questions. Okay, the capital structure of ABC again consists of debentures, preference shares, equity shares and retained earnings. The weight of each security, now they have given me the weights also, is 28.57, 9.53, 14.28 and 47.62. Specific cost of capital of all four, from debentures to preference shares, equity shares and retained earnings, is also given to me. I am supposed to just find weighted average cost of capital. So now this has to be like within a minute. So we do not want any amount, cost of capital, weights are also given, weighted average cost of capital immediately. So we have debentures, we have preference share capital, equity share capital, retained earnings. Okay, cost is given to me as 14. You can write the weights first, then the cost in which ways. Okay, 10.5, 20.0, 18.0. Weight is also given 28. Just don't skip, read the question properly, okay, and assign it properly. 14.28 and 47.62. Multiply. How will you multiply? To the cost, apply this weight in the percentage form. Otherwise, your answers will come in very big numbers. Okay, so you will do 14.6 because the weight is in percentage. No, so please put the percentage. 14.6 into 28.57%. So then you will get a proper amount number 4.171. Then you will have 1.006, then 2.856, 8.571. Okay, so this is how I am getting the answers. So weighted average cost of capital, if you will come to the closest of the decimals, 16.60. Number 4 is also solved. Okay. Question number 5. A company has issued 10,000 equity shares of rupees 100 each. Its current market price is rupees 98 per share. And the current dividend is 4.5. Current dividend, DO. The dividend are expected to grow at the rate of 10%. Compute the cost of equity share capital. So here I am going to put KE is nothing but D1 upon the price, okay, plus the growth. Now what is going to be my D1? D1 will be my future dividend, which will also have the growth factor in it. So how will I find my future dividend? DO plus the growth percentage. No, how much is the growth percentage? Plus the growth percentage upon the price. See how I am solving. The dividend, current dividend is 4.5. What is the growth percentage they are saying is plus 10%. The price, its current market price is 98. I do not have to do anything. Just write 98 over here. And here I will write 10%. Okay, now 4.5 plus 10% if you will do, it will come to 4.95. Okay, 4.5 was my current dividend. I am expecting to grow. That means current dividend means DO is 4.5. I want D1. So D1 has to come with that growth factor. Okay, so plus 10%. You will get 4.95. Divide by 98. This you just do it like this now, so that you do not get a wrong answer. Okay, when you will calculate this, this will come as 5.05% plus 10%. So now it will become 15.05% as the cost of equity. Clear? So these are all the exam questions, okay, of cost of capital. Similar lines, similar type of questions they have kept on asking in all the attempts, okay, changing the few numbers here and there. If you have solved all this with me, practice the sums which I practiced with you and revise the way I have done today, you will be secured with 12 to 15 marks at least for your FM paper. Okay. So, thank you everybody for listening to me, and please do subscribe to our channel as well, and also join the WhatsApp and the Telegram group. The links are given in the subscription. Okay, if you all have any doubt, you all want more help regarding the exams or the sums, etc., you can put it in the comment section of this video. Also, you can follow me on Instagram as well for the same thing. Okay, my Instagram account is with CS Fatema Kagalwala only. So you need any help apart from this, you can definitely get in touch with me. Okay, and please do share with the ones who really need this. Yes, executive level FM paper, one of the most important, interesting paper, and it can help you clear your group if you get good marks. Okay, so all the best again, everybody. Okay, see you all again soon with the other revision chapter. Okay, thank you. Bye bye.